diversify. Now, by the way, if these are all stocks, what happens when the stock market crashes?
They all do.
All of them are going to come down. So my philosophy for you is to start, some of these investment units have to be in other things like gold or Swiss francs. You're going to have to do other things other than just stocks, okay? You're going to have to open up your horizons because most people are just looking at stocks, and that's the hardest way to do it. And you're not diversified if it's all in stocks. People think they go into mutual funds that they're diversified. You're not, because it's all in stocks. And if they come crashing down, you're going to lose your money. All right. So the next thing is, how do we execute the plan? So remember, we buy, we got to sell stop. As it moves up, the sell stop starts trailing it. And eventually the sell stop gets you out. And I'm going to show you actual trades that we've actually done that way, okay? Where the sell stop finally got us out. The only diversification you can have is to go into other things. By the way, we also, in the old days you didn't do it, but now we also, in these investment units, we also sell short. That is, we make money on the downside. So, and I'm going to show you how to make money on the downside when markets are crashing. I want to make money there, okay? So we're going to look at how we do that. So this has got to be very strategic. It's not just one thing. You've got to be very flexible to be able to do a variety of different things in here, okay?
So 3 of the 10 should be outside.
Well, it could be half. And you see, the thing is, your personality is going to come into play here. So your personality is going to dictate what we do and how much we do, okay? So what I want you to think about is this, is that I just got to be diversified, but every student that comes to me has never done foreign currencies or commodities. Once you start training with me, guess what you're going to be doing? Almost exclusively. Either foreign currencies or commodities, because it's the easiest way to make money. Now, the problem is, it's also the highest risk way to make money, okay? So it's a two-edged sword. But if you have a plan and you know what you're doing, it is one of the better ways to make money. And you can see some of my students' accounts, and they do phenomenally well. And they do well because they got a plan and they know how to execute the plan. So we've got our plan, we know that we've got to get into different investments, all right? We know everything we ever buy or sell short. Sell short means you expect the market to come down and you're going to make money when it comes down. We always have a stop loss in place, okay? So, here's how we're going to execute the plan. How do we execute this plan? So there's several ways of looking at the market. One is called fundamental analysis. Can anyone tell me what fundamental analysis is? Anybody know what fundamental analysis is?
They're looking at the industry they're in, the company's in a robust industry, for example, and what quadrant of that industry are they within?
So in other words, you look at their sales, their debt ratio, their price to earnings, what does their management look like, all the fundamental reasons why you should buy a company, okay? And 99% of people look at fundamental research to make a decision to go into something, all right? My question to you is this: could they lie to you? Yes. That couldn't happen, could it? So they could lie to you, so that's number one. And everybody else is looking at fundamental analysis. Here's what I'm going to tell you today. If everybody else is doing it, guess what? You don't want to, all right? I want you to repeat this phrase for me, okay? The herd always gets led to slaughter, all right? So the herd always gets led to slaughter. So everybody's always doing the same thing because they figure if everybody else is doing it, it's
good.
It's probably a good thing to do. Folks, beginning today, you've got to be different. You've got to think for yourself. You got to be independent, think for yourself. You got to go against what everything you've been taught before, because what you've been taught before ain't working. Okay? So you've got to be going against the grain and learning something different. So one of the best ways to learn this is to use what we call technical analysis. And technical analysis is basically looking at chart patterns. looking at a chart pattern and deciding, is this a good time to get in, or is this a good time to get out, all right? And the chart patterns will talk to you and tell you exactly that information. So you have to learn to read a chart to see what the charts tell you, and the charts will make you very, very accurate. Once you get good at this, will make you very accurate at predicting whether something's going up or down, okay? So you have to get good at chart analysis, and that's technical analysis. Very few people ever learn to read charts, all right? And by the way, I also teach Japanese candlesticks. Japanese candlestick chart patterns have been around over 400 years. I tell all my students, nothing stays around for 400 years if it does not work. So you can actually get very good at just looking at Japanese candlesticks and just using those to invest, if that's the direction you want to go. Folks, there's dozens of ways of doing your investment plan. So it's going to be based on your risk tolerance, your personality, what you enjoy doing, you know, all of those things. So, but all of the plans, no matter what plan you engage in, has to have chart recognition, pattern recognition. Because how do you know if it's a good time to get in or not? And the only way you know that is through a chart. And so the charts tell you when it's a good time to get in and when it's a good time to get out. You can always still use your stop loss to get you out. But the chart's going to tell you exactly when you need to get in. And that's what we're going to be covering today. How do I get in using technical analysis, all right? So I'm going to teach you one specific pattern today. There are probably about 38 patterns that I teach. However, you eventually get down to about 5 to 7 that you use very consistently, but you need to learn them all so that you know what you're looking at, and you see something, then there's some recognition, okay? So I'm going to show you just one today to kind of get you started, but it's in pattern recognition, looking at charts and understanding what is going to make money, what's getting ready to go up, what's getting ready to come down, all right?
And why do you like to use, or why do you suggest using commodities and FOREX rather than
Because of
equities?
the leverage. You can buy commodities a lot of times. You know, for example, foreign currencies. You can buy a contract of $100,000 of Swiss francs for about $1,200, $1,500. In other words, so it's like going out and buying a $100,000 piece of property and only having to put down $1,000 or $1,500. So if it moves 10%, $10,000, that's a huge move because you only put up $1,500. So the leverage is phenomenal on those investments. So you can make money very, very quickly, very quickly. You can also lose money very, very quickly if you don't know what you're doing. But here's what I will stress to you. If you get involved in my ongoing program and other seminars that I do, what I am going to tell you is you must always, when you start with anyone, me or anyone else, if they don't demand and insist that you open a practice account for 3 to 6 months, you're wasting your time, because how can you know if you're going to make money until you prove to yourself that you can do it? And that takes about 3 to 6 months of practice in a practice account with no real money. Because eventually, the only person that can prove this to you is you. And I'm going to teach you and guide you, but eventually the only one that can do it is you. You have to prove to you that you can do it, okay? And the way you do it is by opening up a practice account. So you practice, practice, practice. But you know what? If you told me, I want to be great at playing the piano, golf, or tennis, what would you have to do?
Practice.
So it's all about practice, folks. You're still going to have to go practice, yeah? So, but you're going to be practicing technical analysis, chart pattern recognition, and that's what's going to get you good at determining where the markets are and where it's time to get in or out. So you want to have, number one, what's my plan? Where are my stop losses going to be? By the way, in stocks, it's 20%. I mentioned to you, though, in foreign currencies and in commodities and other investments, it's going to be a dollar amount based on the amount of pie that you have. So let's suppose that Asha's pie is 100,000. That's your total portfolio, 100,000. So in any professional traders, by the way, in years past, if you talk to professional traders back in the 60s, 70s, and 80s, you know what their stop losses on any one trade, if I'm going to go into Swiss francs, if I'm going to go into gold, I'm going to go into Exxon stock, my stop loss is somewhere between $1,000 to $1,500, which represents 1 to 1.5% of the total pie. So in any investment, you're usually looking now, of course, if you got $20,000 and that's it, well, then your stop loss may be 3 to 5% because you have to give it some room, okay? So in foreign currencies, you would trade mini contracts instead of a standard contract. So there's ways of figuring out how to limit your losses. The problem is that nobody makes money is because they take huge losses and then they blow themselves out of the game. You're out of the water now. So what this does is if you're taking small losses on every trade, well, you can have 100 trades be wrong and still, finally get out of the game. But in 100 trades, folks, you're gonna, what's the old saying? Even a hog can find I can't remember, something about an acorn, a blind hog can find an acorn. Sooner or later, you're gonna get one that's big. Sooner or later, you're gonna get one, and that's all what you're looking for. All you're looking for is keep the losses small until I get the big one, and eventually you will get the big one. And that's what you're looking for. But the problem is most people take those big losses and then they're dead. Catastrophic losses and then you're dead in your portfolio. So you gotta get rid of the catastrophic losses. So from now on, when you go into something, you already gotta know exactly how much you're gonna lose if you're wrong. You have to know that number. You have to know the number. If I'm wrong, here's how much I'm going to lose on this trade. You have to know that number. And nobody ever does that kind of planning. Nobody ever knows, well, what's the number? So what's the number I'm willing to lose if I'm wrong in this trade? So we want to look at chart patterns, and I'm going to show you just one today. And as I mentioned, there's actually about 38 that I teach you over time, and that's why you want it over time. You don't want to try to learn all of this in 2 days. You want it spaced out. So I found that people learn best through spaced repetition, that you're doing it over and over and over again every week. We're practicing, we're getting together, and you're learning, and then you open your practice account, you're practicing today, you're seeing why you made money, why you didn't make money, and then again, within about 3 to 6 months, you are then confident that you already know what you're doing at that point, and that's why you have to do it in a practice account.